The cost of the phrase, "This time is different," to the investor. One of the most expensive phrases in financial history is, "This time is different." This statement generally means, "This isn't a bubble. This crisis isn't permanent. This company will never go bankrupt. This technology will change everything." However, history shows us that the market changes, but human psychology doesn't change much. 1. Historical background. The same story, different scene. In their book This Time is Different, economists Carmen Reinhart and Kenneth Rogoff analyzed 800 years of data on financial crisis. Result? In every major debt and asset bubble, investors said, "This time is different." Common pattern. New technology. New financial instrument. New economic order. New central bank policy. But the result is often overvaluation, overborrowing, sharp correction. 2. Why is "This time it's different" said? 1. Overconfidence. The investor trusts their own analysis more than necessary. "The previous ones were wrong, but I see it." This increases especially in bull markets. 2. Story fallacy. The human brain loves stories. For example, "Artificial intelligence will change every industry." "This company will transform the world." The stronger the story, the more the rationality of the price is not questioned. 3. Herd mentality. If everyone is winning, risk becomes invisible. During bubble periods, risk becomes normalized. Valuation becomes irrelevant. Fundamental analysis is declared old-fashioned. Examples from history. 2000 dot-com bubble. The future of the internet was correct, but prices were irrational. Result? Nasdaq fell 78%. Many companies disappeared. The investor's motto at the time, "The internet age has broken the old rules." 2008 housing crisis. The prevailing belief in the U.S. was, "House prices will never fall nationwide." Result? Global financial crisis. Bank failures. Loss of trillions of dollars in wealth. 2021 period of excessive liquidity. Central banks always save the market. Interest rates will remain low forever. When interest rates rose, many highly valued assets lost 50 to 80% of their value. What is the real cost? 1. Capital loss. Buying overvalued assets because they are different leads to significant losses during a downturn. 2. Time loss. It can sometimes take 5 to 10 years for an asset to return to its previous peak. During this period, inflation continues. Alternative opportunities are missed. 3. Psychological devastation. Large declines can lead to panic selling, complete abandonment of investment, loss of confidence. 5. Why is this phrase dangerous? Because this phrase usually hides the thought, "This time there is no risk." However, risk doesn't disappear, it just becomes invisible. One of the fundamental realities of finance is this: as the expectation of return increases, so does the risk. Easy money periods are not permanent. 6. Psychological mechanism. This thought usually emerges near the peak. The reason? A long period of growth creates confidence. Volatility decreases. People begin to forget the possibility of a decline. At this stage, the investor underestimates historical examples, sees warnings as fear. It ignores valuation metrics. 7. Common characteristics of those who say, "This time is different." Claiming a new paradigm. Declaring old rules invalid. Belief that risk has been eliminated from the system. But history tells us, technology changes. Monetary policy changes. Human psychology doesn't change much. 8. A lesson for the long-term investor. The real question is this really different, or are we just getting carried away? And this filter can help. Is the valuation reasonable? Is the debt level sustainable? Is the return expectation realistic? What is the worst-case scenario? Strong conclusion. "This time is different" generally means we are approaching the end of the cycle. The biggest losses usually occur during peak periods, during the greatest optimism. A disciplined investor looks at the data, not the story. Trusts the system, not emotion. He seeks not what is different, but what is lasting.